All right, great. Hi, everyone. Thank you for joining us today. I have Bob Adams, who's going to be talking to us about reverse mortgages. Now, I know some of you may have heard some horror stories about reverse mortgages. There's a lot of misconceptions. So I really wanted to do this webinar to talk about some of the misconceptions that are out there and give you some examples because as we were talking with Bob, we discovered that there is great opportunity for you to move into your new home, dream home, that you may not have thought is possible with no mortgage payments. So let's find out. Bob, thank you so much for joining us today. Really appreciate you being here.
It's great to be here, and to be working with your new home team and your concept of main level living lifestyle. Your group is forward thinking and progressive, and not a lot of people know about these programs that you're bringing to the fore to help people learn how they can own their home with a method that they're not familiar with.
Yes, and people are going to actually discover that they can actually buy new homes with this opportunity, which is a great opportunity for those who are looking to move into a home that they may not have thought that they could qualify for. But I'm going to let you run with this and just go through. And I know that there's going to be some scenarios, but you're also going to be available for a consultation with those people who are going to be interested in it. So I, again, want to just thank you very much for doing this for us. And if anybody does have questions, we look forward to answering those at the end of the webinar.
Okay, great. Thank you so much, Ida. Let me point out, first of all, that what we're going to be talking about today is one of two different methods of using a reverse mortgage. Many people are familiar with a reverse mortgage refinance, where someone is living in their home, wants to stay in that home, has equity in that home, and wants to use some of that equity to improve their lifestyle and allow them to stay in that home. Okay? That's the traditional HECM, home equity conversion mortgage, that has been around since the late 80s. What we're going to talk about today specifically is the home equity conversion mortgage for purchase, and we have a shortcut for that, a nickname for that. We call it H for P, and it uses a reverse mortgage in order to purchase a home. And the amazing thing about it is that there will be no monthly payments, and I'll show you how that works as we go along. But right now we're talking about using a reverse for purchase to move into a dream home with no monthly mortgage payments. Okay. I'm having trouble changing my screen here. I'm not able to move to the next slide. Okay, there we go. All right. Who can use this program? Who can use the HECM for Purchase program, reverse mortgage for purchase? They have to be 62 or over, okay? If it's a couple, one of them needs to be 62 or over, okay? You need to have sufficient cash to purchase a home, and we're going to talk to you later about what that down payment needs to be. And this is very easy to qualify for. You know, today, many people are fearful, as they should be, about qualifying for a traditional mortgage. You've got to be pretty doggone strong credit-wise, and many people are. But, of course, you'll have a large monthly mortgage payment unless you pay all cash for your home, which in many cases is not the best choice. So it's very easy to qualify. We look for the home buyer to have the willingness to pay their bills, which means credit. We need capacity, which means sufficient income. And if we don't have those things, or they don't meet the standards that HUD has set, we now have a program. We've improved this program so much. We have a way to escrow your property taxes and insurance and other home maintenance, like HOA fees, etc., your property charges. We have a way to escrow that for you, much like many traditional mortgages do. Okay, let's talk about some misconceptions. I have been doing this for about 7 years, and I'll tell you, I've heard just about everything from many, many people, some of whom are, professionals, elder law attorneys, CPAs, um, financial advisors, and, none of us can keep up with everything. But there are some major misconceptions out there that we need to blow away for you because they're not true. Okay, the first one and the one I hear most frequently is, even if it's not spoken, people think that the bank will own the house. Okay, let me point out that using a reverse mortgage, whether it's for refinancing your property or purchasing a new home, is just the same as another lien on the property. Okay, there's a lien recorded at the courthouse in the name of the bank, the lender, for your reverse mortgage, but you are still on the title. Nothing changes on the title. Okay, so who owns the home? You do. All right. Then people think that when I die, then the lender, the bank, comes in and takes the house, and they get to keep the money if there's any left over. Well, that's entirely untrue as well. This works no differently than a traditional mortgage lien. When you pass away or sell the house, you pay off the reverse mortgage, and any equity left goes to you, or if in the case of you're being deceased, it goes to your estate. No different from the mortgages that many of you have today, okay? Often people think that this will eat up every penny of equity in my house, and there'll be nothing left for my kids. Couple things to talk about here. First of all, when you start off with a reverse mortgage, you are going to have about 40 to 50% of equity in your home from the get-go. In other words, reverse mortgages do not lend up to 80 or 90% of your home. So you have a nice equity cushion to start with there, okay? Over time, because you're not making a monthly mortgage payment, the interest that a bank would normally collect is simply added to your mortgage balance. So your mortgage balance will go up over time unless you make payments, which you're allowed to do anytime you want to. So it takes a long, long time to eat up the equity in the home, okay? We start with a nice cushion, and we anticipate some appreciation of the property, as we've seen historically. So that idea that there's not going to be anything left for the kids is not necessarily true. If you live long enough, that might be true. Now, I'm going to point out one other thing. Adult children of reverse mortgage holders, or I should put it this way, adult children of elderly folks, okay, may need to help their parents with living expenses. The income of these elderly people is flat now, and they're not in their high earnings years. So there needs to be assets in order to support their lifestyle. Now, sometimes those assets that are eaten up are investment accounts or savings accounts or whatever other funds they might have. But no matter where it comes from, your elderly parents are going to need assets over time that are going to dissipate, okay? In this case, you can choose to have some of the equity in the home dissipating over time instead of the investment portfolio. And without getting too deep into that, let's just say that when I work with financial planners, setting up an alternative source for retirement funds gives your financial planner and you choices to make. For instance, when the stock market was doing terribly a couple of months ago, that was not a good time to call your financial planner or broker and say, I need 20 grand, or, keep sending me my $3,000 a month. So when it comes to leaving something as a legacy, as an inheritance, you're going to use assets. We just want to give you a choice of where those assets can come from. We've even heard people say that, if I go to the hospital and I stay there for 2 weeks, I won't have a home when I come back. I actually had a learned person, a surgeon, an orthopedic surgeon, tell a patient that. Misconceptions, okay? Some people have said over the years that these loans are terribly expensive. There were some more expensive loans in the past. Like many aspects of this program, that's been improved immensely. And today, these mortgages have closing costs that are very similar to any other kind of mortgage, with the exception of the FHA insurance, which is a very important aspect of this whole program. And all FHA loans will have this insurance cost. But we can talk about that on an individual basis, and I can answer very specific questions about that. Okay? People say, I won't be able to sell my home. Okay? What if I buy a house with a reverse mortgage? And then I decide that, you know, I made a mistake, or I decide later I want to move to Florida or whatever. Now I'm stuck because I own a home, but I have a reverse mortgage on it. I have to emphasize again, this is a lien against the property. It has nothing to do with the ownership of the property or your right to sell your property. Nothing to do with that at all. Some people think that taking this program and will cause them to lose their Social Security income. Absolutely false. Does it affect Medicare? Absolutely no. Some people think, well, this is only for poor people, especially in the case of a refinance. That has changed dramatically, where now HUD has put together rules that make us look at willingness and capacity, and also plan ahead with financial planners to use this as a tool for retirement, not a lifeboat. And I'll be glad to go into that more with any of you individually. Okay? Another point, I can't do this, I already have a mortgage. Well, in the case of a refinance, we're going to use the funds from a reverse mortgage to pay off your current mortgage, so you have no payment whatsoever. Okay? In the case of a purchase, you will have only a reverse mortgage. Okay? If you're coming from a home that has a mortgage on it already, many people sell that home, what we call the departure home, and then move into their new home using a reverse mortgage, and they use the cash from their sale after paying off their mortgage to bring a down payment to the new home purchase. Okay? If you're talking about a refi, we pay off your mortgage. So I should also point out that for people who are buying a home with a reverse mortgage, the H for P, they can still own another home with a mortgage on it. Perhaps Ida's team is going to list that house and sell it for you. You don't need to wait to take advantage of a new opportunity with the dream house that you want, as long as you have the cash to get into that new house, and we can show you have income to carry the older house and pay the taxes and insurance on the new home. Okay? More detail anytime anybody wants that. Okay?
That was great.
So those are.
I just want to talk about, just give two scenarios. We have one, while you were just talking about that, one where they need to move their parents out of the property, existing property, get them into a new property while they're getting the other property ready for sale. And that's a great opportunity for them to be able to do that with a reverse mortgage.
Absolutely.
Yep. And then the other one that we were talking about earlier was when we have a couple who may have retired, they sold their home, and they only think they can qualify for a specific amount. You know, they're going to take all their earnings from the equity from the sale and put it into the new home, but they only think they can qualify for a limited amount. With reverse mortgage, now they can qualify for, I mean, they're looking at a new home now, which is their dream home.
Exactly. You know, what we can do, and it'll become clear as we move through this presentation, we can basically double the buying power of a couple or a person, senior citizen, that wants to own a new home, because they're going to come to the settlement table for their new home with a certain amount of cash. Our company, Retirement Funding Solutions, can bring to the table money from a HECM for purchase to complete that transaction. So usually they need to use half or less of the cash that they might have in pocket or might come out of from a previous home sale. It allows them basically to buy twice the home that they thought they could buy. Does that make sense?
Yeah, I mean, that's great. So I know you're going to go over it now, but I wanted to just interject that because it's an opportunity that even us as agents haven't really thought about before when we have clients looking and they feel they can only qualify for a specific amount. And this is an opportunity not only from the qualification point, which you expand upon, but also getting into their dream home, maybe something better or newer that they were looking at.
I'm working with a lady right now, Ida, who is a good example of what you're saying. She's been looking at $300,000 properties, and she's very disappointed in what she's finding. She doesn't feel attracted to those properties. She's moved in here from a different area, and as you know better than I, sticker shock can sometimes hit people that come to the Washington, D.C. area. So when she learned through her realtor about the H4P program, she has about $300,000 in cash. She's 66 years old. We can come to the table with about 55% of the purchase price of a house. So she can now look at $600,000 houses, use the cash that she has, and never have a mortgage payment for the rest of her life. Mm-hmm. It's quite a program.
Yeah. And also I know that you were talking about the fact that sometimes people do some of these and give money out to their grandkids or their kids to purchase their home as well, to be able to pull that money out and do that.
Exactly. So I've had several instances where someone like you, someone on your team, a professional realtor, is working with a younger couple who are trying to get into their first home, or they're trying to move up. And as you know, as many of the people listening here have probably heard of or even experienced, they may be $20,000 away from making that purchase and buying the home that they really want. And oftentimes, relatives will gift that money to get them into that home. But some parents and grandparents don't have that money in cash, but they certainly have it in equity in their homes. So there's a case where we can do a refi with a reverse mortgage, produce the cash to mom and dad or grandpa and grandma, who can then gift it to your younger couple buying their first home or moving up. So using home equity to purchase a home is a concept that is gaining much more acceptance. It's becoming more frequent. More people are learning about it, and it really works.
Yeah, I mean, it's a great opportunity, at least just to investigate what it would cost them to go through that process and the benefits of it.
Exactly, and we can get into a lot of detail, and I can speak with people about specific cases,
yes.
But grandma and grandpa don't have to take every penny of their equity out. They can take out just enough to help their children or grandchildren. Mm-hmm. So we can always work on that on an individual basis.
Great.
So today we're going to go ahead, Ida.
No, sorry. I just said that was great.
All right. So today we're going to learn what a home equity conversion mortgage is. That's the official name for reverse mortgages, HECM from HUD. And why you should consider using a HECM instead of paying cash or getting traditional financing. We'll talk about how the HECM program works, and we'll look at some case studies using this and the results that have been achieved. So why should you learn about this HECM program? Well, you can buy your dream home for as little as 44% down. And let me make another comment on that. The older you are, the more money we, Retirement Funding Solutions, will bring to the table, okay? The minimum age is 62, We have 75-year-old people, obviously, and older that are moving from one home to another using this program. And the older one is, the larger percentage retirement funding solutions will bring to the settlement table. I'll show you a chart that you can predict what would be needed at certain price levels and certain ages. So, why should you learn about this? Another reason, you can enjoy having no monthly payment. I hear a lot of people say, Bob, that can't be true. It's too good to be true. Well, it's a government program, and it is true, and it does work, okay? The bank is going to get their money eventually. I mentioned before, instead of people writing a check like I do every month to a mortgage company and having their mortgage balance go down very, very slowly over a long period of time, instead of doing that, Retirement Funding Solutions says, look, you don't have to send us a payment. We're going to make money, but we don't know when we're going to get it. That depends on you, when you leave the property or when you're deceased or whatever. So in the meantime, instead of sending us a check, we will add the interest that you would normally pay every month to the mortgage balance, okay? That's why we talked about equity being used over a long period of time. So another reason why you should learn to use this. Use that freed up cash that you don't have to put down on your new home for more important things like investing, traveling, hobbies, or the grandkids you love to spoil. When I got into this business about 7 years ago, I worked for MetLife Bank, a wonderful company, MetLife, and they fund a very, very strong research institute called the Mature Marketing Institute. They found that the #1 thing that parents and grandparents want to do for, in terms of financial goals, they want to help their kids and grandkids. So people that are buying and not having to use all their cash are able to do that. So by the end of today's presentation, we promise that you'll know what a HECM is, how to qualify for a HECM, what type of property it can be used for, and who really owns that property. Now, one of the big problems is people say, well, I have to sell my existing home prior to purchasing my dream home, okay? That's not necessarily true. Now, the HECM for Purchase program allows you to buy that dream home for as little as 44% down. And by the way, 44% is for a person right around 72 years old, okay? A person that's 62 years old would have to put down about 48%, all right? So you eliminate the need to have your existing home sold, because if you have the assets to put down, you don't have a monthly mortgage payment, so you can still carry your, what we call a departure home. You don't have to sell it right away. It can stay on the market while you're enjoying your new home with no mortgage payment. Another problem is that home values have plummeted since 2008. So there's been lost equity and a longer sales cycle. Ida and her team will tell you that that problem is going away. Prices are rebounding and sales are picking up. So you have a better chance today, especially with full-time professionals like Ida's team, to sell your departure home. And so you're not carrying it for a long time. But if you qualify income-wise to carry your old house and pay the taxes and insurance on your new home, you're good to go. So a solution is using the HECM for Purchase program. You can sell your home for less if you need to, resulting in a quicker sale, and still get everything you want in your new home. Because basically, we're bringing half the money to the table that you don't have to bring, and you won't have a monthly mortgage payment. So there's another problem. You can't get what you really want in your dream home because you're on a limited income and you don't want to put all your cash on the line. All right, well, we know that using the HECM for Purchase program, you can retain a large portion of your cash and still live in the home of your dreams with all the options you want. Now, one of the biggest uses of this HECM for Purchase program is with people buying new construction, for instance, in 55-plus communities. 55-plus builders are finding this to be tremendously effective. It's increasing their sales by about 30%. And of those 30% of new buyers they find, 85% of those buyers would not have otherwise qualified to own that home without us coming to the table with roughly half of the money. And we mention here all the options that you want, okay? If you want that marble countertop and, you know, the extra landscaping and the sunroom and the big front porch, you're basically getting those things for half price, and you don't have a monthly mortgage payment. So what builders love about this is that of those 30% increased buyers, 85% of whom would not have otherwise qualified to buy the home, 90+% of those people are purchasing every option that the builder has to offer. And why not? We want this to be your dream home, and we'll help you make that happen. Okay, so lost equity results in less money available for a down payment on a new home. Again, things are improving a little bit, but if you're counting on using all the cash from a sale of a home to buy your new home without any financing whatsoever, then you may well have to settle for less than what you really want. And that's not your dream home. We can help you to get to your dream home. Now, let me give you an example, and I'm just going to use one example. I'm going to go all the way over to the right of this matrix and talk about a purchase price of $400,000, okay? Because we're in Chantilly, Virginia right now. I don't know that there's many $250,000 properties that would be your dream home. So if we're buying a $400,000 house and we're 65 years old, look at the left column, the age. If we're 65 years old, we need to bring to the table on a $400,000 house almost exactly half, $199,986. Now that includes all of the closing costs. That's the cash needed. So if you had sold, here's an example. Recently some folks sold the family farm in rural Pennsylvania in order to move down here, and they purchased in a 55-plus community to be closer to the grandkids. I mean, how surprising is that? So if they collected $400,000 from the farm in Pennsylvania and they want to buy a $400,000 home here, they could use every penny that they have, or they could keep $200,000 in cash, let us come to the table with the $199,986, and they own their home, they're on the title, they never have a mortgage payment. Okay? One more quick example. Let's say that an older person, I want to illustrate the increased amount of dollars that we bring to the table for older people. Let's move forward 10 years to a 75-year-old buyer. That buyer, to buy a $400,000 house, will only need about $180,000. So you can see that there's about a $20,000 difference between what a 65-year-old and a 75-year-old needs to bring to the table. So, have you ever heard of a reverse mortgage? Many people have, and usually we get a negative reaction because there are some stories out there, some of which have a semblance of truth, many of which don't. Okay, they've been around since the late 80s. They're insured by FHA. It lets homeowners use a portion of the equity in their homes to turn it into cash and eliminate their monthly mortgage payments. That's the case of a refi. They're already in a home they want to stay in, they have equity, but they'd like more income or they need some cash. We can use the equity through using a HECM or reverse mortgage. Okay, that's been an incredible financial tool for a lot of people. It's in the forefront now of financial planning by very learned financial advisors who now understand that with the changes in the HECM program, this is a very safe, very solid, and great program for people when it's suitably applied. So, how it came about for you. Okay, this is a variation, the purchase is a variation of the reverse mortgage. And it works exactly the same way on the back end, but it's the exact opposite on the front end. In other words, it's kind of the reverse of a reverse. Instead of refinancing our home and getting some cash out, we're going to buy a new home and we're going to get some cash from Retirement Funding Solutions, the reverse mortgage lender. Okay? In the past, that kind of transaction was Ida and her team would sell your home, your departure home. You'd put some money in your pocket, and then you'd go find a new home. You would buy that home with the money that you had in your pocket and some traditional financing, if you could qualify. Then people would say, okay, now I want to get rid of my mortgage payment. Let me do a reverse mortgage on this new home. So that was a traditional way to do it before 2009 when this little-known program came into play. So it eliminated the monthly payment on their destination home, but it was two transactions, okay? Selling the old home, then getting three transactions really, but as far as the destination home, their new home, they bought it and financed it, or they used cash. And now they're doing another transaction to do a reverse mortgage on it and eliminate the payment. So you have two sets of closing costs, okay? We have a better way to do that. In 2009, we created this program, or HUD did, to be able to do that with only one transaction, using cash from the departure home to put down on a new home and having Retirement Funding Solutions bring the rest of the cash to the table and never have a monthly mortgage payment. Okay? So a traditional mortgage is, let's say you have a $100,000 mortgage, and what happens is you write a check every month. We talked about this a few moments ago. And the balance of your mortgage actually goes down. Now, it goes down very, very slowly. Believe me, I'm privy to that. But it does go down over time where eventually you pay off your mortgage. Okay? So if we're talking about a $100,000 mortgage over time, each month you make payments, and a little bit of it is reducing your principal, usually not a lot, especially early on. If you're buying a new home with traditional financing, it's going to be a long time before you're making any dent, real significant dent in the principal. So over 30 years, the mortgage balance does get paid in full. But you would pay about $300,000, 2.5 to 3 times for that type of financing to own your home free and clear and not have a mortgage payment. We can start you out with a nice equity position and not have a mortgage payment for the rest of your life, as long as you're in the house, you or your spouse. So with the HECM, if you get a $100,000 mortgage, you don't make any payments. The interest gets added to the loan balance because remember, the lender is going to make money. They just don't know when they're going to get it, okay? That's going to be your choice. And that balance grows over time instead of going down. And that's exactly the way it's designed, so that you don't have to pay current interest on your mortgage. It accumulates over time, which is a better way to enjoy your retirement for many, many people. So who wouldn't want to move into their dream home? Not settle for less, but move into your dream home without making any payments and not using all of your cash. So you have those other opportunities we talked about before. all right? Not many people plan on buying their dream home and then moving out, okay? So this is usually the last stop on your home buying life, and you're buying your dream home. That's where you want to stay. So you can live there as long as you want without any mortgage payments. That's what we usually see. People plan on living out the rest of their life there, okay? If something comes up, as we said before, and you need to sell and move, you own that home just like any other homeowner does, whether they have a reverse mortgage or a traditional mortgage. Your rights are not restricted in any way whatsoever. So what if you move in 5 years? All right. You sell your house for $200,000, let's say. Your mortgage balance is $125,000. That means you're going to walk away with $75,000, okay? So what if you move in 15 years, okay? Usually for most reverse mortgage buyers, about 15 years is what we call the crossover point, where the balance of the reverse mortgage is essentially the same as the value of your house. So that if you sell the house, you pay off the mortgage, you're not walking away with cash. But of course, you've lived without a mortgage for 15 years. That's the crossover point. You know, most of the calculations that I do show it closer to 20 years. But anyone who's interested in looking at numbers, we can do an amortization schedule based on your age and the value of the property that you're looking at, how much cash you will need, and when is your crossover point. So, minimal credit requirements, we talked about that before. Minimal income requirements. All we really need to know, and this is what HUD has mandated for us, that we need to be able to show that you can pay your property taxes, your homeowner's insurance, and other property charges like condo fees or homeowners association fees and things like that. This is part of the new and improved HECM program, and it really started in April of last year, April of 2015, where before, and this is what caused some problems, an irresponsible lender could lend a bunch of money to somebody who had little or no income. They used up all that money to pay off their mortgage, or they gave it to the grandkids or whatever, and then found themselves in a position where their income was so low that they couldn't pay their taxes and insurance, okay? We've changed that now to make sure that we protect homeowners, elderly buyers, so that we know they're going to be able to live there without the strain of not being able to pay taxes. In fact, in some cases, as I mentioned earlier, we can set aside the taxes and insurance. So it's a much improved program in terms of the safety and keeping elderly people in the dream home that they want to be in. Minimum debt to income ratios, it's not nearly what a traditional mortgage requires. You never have a monthly mortgage payment, ever, okay? By the way, you can make payments if you want. I have a few clients that do, but you know, it's totally up to you. There's no prepayment penalties, no restrictions. You can make payments whenever you want. So how do I qualify? Well, you have to be 62 years or older. It has to be your primary residence. It can't be a home at Rehoboth Beach that you go to 2 weeks every summer and rent out the rest of the year or summer. The money to close must come from asset accounts or a debt or gift. It cannot be a debt. In other words, if we say to you, look, we'll bring $200,000, you need $200,000, you can't go to another property that you might own, a beach house at Rehoboth, and borrow $200,000 from that and bring it to the settlement table, okay? It has to be from assets that you already have, or the proceeds from a sale, or a gift. That's where grandma and grandpa might come in for a younger couple. And even sometimes elderly buyers will get a gift from their adult children. What type of property can I purchase? New or existing single-family residence or planned use developments. An FHA-approved condo. And by the way, Retirement Funding Solutions, if you find a condo that you want to own, we will get it approved by the FHA for you if it's not already. The maximum claim amount is $625,500. I want to explain that briefly without getting into too much detail. The maximum amount that HUD will allow us to compute your cash available for is $625,500. So if you go find an $800,000 home that you want to buy, and you want to know how much cash you're going to need, and you're 65 years old, well, we can bring to the table, in that case of 65, 54.2% of $625,500. Whatever the factor is for your age, we can bring that much money times on a $625,500 home, okay? The result of that is that you have less cash in terms of percentage of the property, but you also have a higher equity position right from the get-go, okay? And I can explain that in detail to anyone who wants to ask. What could disqualify me? Well, if you have unresolved federal tax liens, it's okay if you have a tax plan and you're making payments to Uncle Sam, but if you have an unresolved lien, then that's going to disqualify you. That has to be paid before you purchase a home with reverse mortgage proceeds. A Chapter 7 bankruptcy less than 24 months from discharge. So it's okay if you had a Chapter 7 3 years ago. A foreclosure or pending short sale or deed in lieu within the last 3 years, okay? If you have an existing FHA mortgage on your name, in your name, we can't do it. You can only have one FA insured mortgage in your name at any given time. If you have property tax arrearages over the past 24 months, that could disqualify you, but today we do have a program called a life expectancy set-aside, where we can overcome that and help you to qualify and get you in your dream home by keeping some of the proceeds that we would normally bring to the table aside for you in escrow so that we can pay those charges for you. So you're not entirely disqualified. I've worked with a lot of people, and you know, it's like anything else. You get a professional who knows what they're doing, and there are often ways to make things happen. So what are you responsible for? You've bought this dream home. You used only half the cash that you thought you might have to, or you used your cash and bought twice the home that you had dreamed of having. So what are you responsible for? You have to keep your property taxes paid, okay? And you have to keep your homeowner's insurance and any association fees and condo dues up to date. That's what you're responsible for, and a general upkeep and maintenance of the home, okay? You can live in the house until the last borrower vacates the house. So, and let's use an extreme example. In the case of a 62-year-old person with a 55-year-old spouse, okay, we can, now with new rules, we can allow that younger spouse to stay in the home even if the person who's over 62 predeceases him or her. So now what we call non-borrowing spouses, younger spouses, are protected. They can stay in that home as long as they live as well. So here's, well look, I just led myself into this question, didn't I? I just told you that if one person is 62 and the other 68, one thing to point out is we use the younger person for the HUD factor that we multiply the purchase price by to determine how much cash we bring to the table, okay? So if you have both spouses or partners are qualified, the younger person is the one that we use to compute the cash available. The age of the youngest person is used. What if one person's 62 and the other is younger? We just talked about that. We're going to use that younger person's factor to determine how much money is available for this purchase. But if one predeceases the other spouse does not need to leave, okay? One of the huge improvements in the program, which is just recent. Okay, brand new rules that allow the transaction and protect that younger spouse. That was a big objection for a long time. So who owns title to the home? We've talked about this before. You are fully vested in the title of the home as long as the taxes and insurance and general repair is maintained, okay? The home can never be taken away. The only way you can be foreclosed upon is to fall behind on taxes and insurance. Okay, there are no monthly payments. So it's a very, very safe way to own your dream home. It's simply a lien on the property, just like a traditional mortgage. You can sell your home, pay off the lien, take the cash, give it to your kids. When you're passed away, your estate will keep any excess over the mortgage balance that's paid off when your estate sells the home. So when you both die, the house will be left to the estate and be settled the same way as any other estate, okay? There's a lien on the property that needs to be paid off before the kids or the estate get the proceeds. So you could decide whether the house will be sold or will be bought by a family member. An appraised value will be determined. The house will be sold for market value. And if the sale price exceeds what the mortgage balance is, the difference will go into the estate, go to the kids, the inheritance that many people are obviously and reasonably concerned about. Again, you're gonna dissipate assets as you age, which is going to reduce your estate in one way or another. It's either going to come from cash assets or it's going to come from home equity, to simplify it into those two sources. This is a way to have choices about that. Okay, the estate will not be responsible for any deficit. FHA will pay the lender the difference. Let me make this very succinct, and I'm going to give you an example. Mom and Dad bought a house with a reverse mortgage in 2016. 25 years later, they borrowed $300,000. 25 years later, their mortgage balance is $1 million. Because remember, and I'm taking those numbers off the top of my head. Remember, you're not making payments, but the balance of the mortgage is going up, okay? So let's say the mortgage balance grows over time to $1 million. Mom and Dad pass away, or the last one of them passes away. It's time to settle, just like you would with a traditional mortgage. You put the house up for sale in order to pay off the mortgage and keep any cash. All right, now what happens if we've had a terrible housing market over 25 years? I'm going to use absurd numbers. And let's say that $600,000 house, they used $300 in their own cash, and we brought $300 to the table. That's why they had a $300,000 reverse mortgage balance. 25 years later, off the top of my head, that reverse mortgage balance is $1 million. And that $600,000 house has appreciated very, very little. It's been up and down and crazy, but we've had a calamitous real estate event. And when it's time to sell the mom and pop's house, when they're both gone, the house is worth $750,000. That's really unimaginable, but I'm giving you a scenario. So the estate, i.e. the children, sell the house, they get $750,000. But guess what? They owe Retirement Funding Solutions $1 million. So do they all have to kick in and make up the $250,000 deficit? Absolutely not. There is no personal liability for the repayment of this loan. No person or estate can be looked to make up any deficit. Only the property, the sale of the property, is responsible for paying off the loan. And if it can't pay off the loan in full, the estate just walks away. They don't get any cash, but they don't have to come out of their pockets either. That's the FHA insurance. So is this another way that the government's going to get itself in trouble by funding all these deficits? Well, first of all, the example that I gave is ludicrous. But there have been many, many cases where people outlived, they lived for so long and the market wasn't so great that the mortgage balance was higher than the value of the home, okay? And the government FHA insurance made the lender good, okay? But this is funded by the buyers themselves. And in other words, it's not a taxpayer program. It's not a grant or a gift from the U.S. government. I will explain in detail to anybody who wants to know precisely how the FHA insurance works. But suffice to say that the fund is built by the participants in the program. So it's not a drain on our economy. Not a taxpayer-funded program. Everybody contributes to that mortgage fund that makes the lender well. In the case of a regular mortgage, FHA mortgage, the borrower actually has part of their payment every month go into the insurance fund. Okay, it's 1.25% a year, or about 10 basis points per month. In the purchase program, 1.25% per year of the loan balance goes into the FHA insurance fund. The lender contributes that money into the fund. So what are the closing costs? They're very similar to a normal FHA mortgage. Depending on how much cash you put down, 2.5 points of the appraised value is an upfront FHA insurance fund payment. Other fees are like any other mortgage, $3,000 to $3,500. Title insurance, it's determined on the cost of the home and what county, what locality the property is in. But aside from the FHA insurance, which is very, very valuable, might be the best insurance you ever buy, the closing costs are just like any other mortgage. You don't add the closing cost to the matrix. Remember I showed you that a $65-year-old person could buy a $400,000 house and come to the table with $199,986. That includes all the closing costs, okay? The total money that you're going to bring to the table is what that matrix shows. Okay, so if you're building a new home, how does the financing work? We can't begin the application because it's a federally insured program until the certificate of occupancy is completed. So when you're buying a new property from a 55-plus builder, then once that place is ready for occupancy, we can then process your application and get the money to your settlement many times within 15 to 20 days. The house is ready to move into, so you must build an additional 30 days after the house is ready for closing. 30 days is our way of covering ourselves. We often do it faster than that, and purchases are a priority in terms of processing. We have a team that does nothing but process the HECM for purchase, or H for P program. How long does the loan process take? About 30 days. Who brings the money? Okay, you bring the amount required based on that matrix, and we bring the rest to the settlement table. And you own the home and never have a payment. So if you decide to sell your house in 10 years and it's depreciated and you owe more than what I can sell it for, we just talked about that, okay? You're not going to be responsible for the deficit. It's not your problem. The house will be sold for market value. The monies will go to paying off the mortgage, maybe not 100% of it, but whatever's available goes to pay off the mortgage. And any deficit created will be paid by that insurance fund to the lender. So can you use the HECM for purchase program on a new primary residence if you decide to move? Of course you can. You can use the program on your new primary residence. You must sell your existing property prior to purchasing your new home if you're going to use the HECM for purchase. Because remember earlier we said that you cannot have more than one FHA insured mortgage at a time. So you have to take that into consideration. When you sell your existing home, if the mortgage balance is greater than the value of the property, you have to wait 3 years to use the purchase program again. So in other words, if you dipped into the FHA insurance pool, or if your property required that to be done, then you have to wait 3 years before you use the program again. Is the rate fixed or variable? It can be either one. And every scenario is different, and we should talk about that, consult about that, and decide which one is best for you. So how's the bank or the lender, how does Retirement Funding Solutions make money? All right, on a traditional mortgage, a bank charges interest and they get cash flow every month. You send in a check. We're still charging interest, but it's accruing on the loan balance, which causes the loan balance to grow over time. And that's the way the program is designed, for the loan balance to grow over time, so that you don't have to make monthly payments, and that you live in the house as long as you want without a payment. So the money doesn't get paid until the house is sold. All right, the lender doesn't make money until the house is sold. The beauty of the program is that you are not responsible for paying back this debt. The property is. The property and only the property. So does my existing home have anything to do with this transaction? Actually, no. It's a separate transaction entirely. It's only used for the purchase of your new retirement home. You and your heirs are not personally responsible for this debt. There will never be anybody coming to your estate or your kids saying, hey, your house was $50,000 short of being paying off the reverse mortgage balance. You need to go to your sisters and your brothers and come up with the cash. Not going to happen. So, it sounds too good to be true, right? What's the catch? Hear that all the time. So many people don't know about this program. But when they hear about it, they wonder, how can this be? Well, you may want to talk to everybody you know about the program. Most likely, anybody that you speak to will not have heard about it yet and will have the same reaction you had when you learned about it, okay? We are very fortunate now that my industry and my company and myself are making great strides in educating the financial planners and the CPAs and the elder law attorneys and real estate folks like Ida Walsh and her new home team. So some people will know about it, but many won't. Believe me, many of them will just say, oh, don't do that. The bank will own your home. Don't do that. Your kids will never see a dime. Those misconceptions that we talked about at the outset. There's got to be something wrong here, okay? If you go to a bank that doesn't offer this, they're probably going to tell you that there's something wrong because they don't offer the program, okay? A lot of banks don't offer the program because, frankly, the regulatory environment right now is very, very difficult, particularly generated by the Dodd-Frank Act, and a lot of the large banks have gotten out of this business. So I encourage everybody to invite family, friends, neighbors, anybody else that might want to know more about this to one of my seminars that I hold with Ida Walsh and her team. We do webinars, and I also offer a one-on-one meeting, which is free, a free consultation. But don't try to present this program over the dinner table by yourself. I don't want to be too blunt about it, but you will not be able to communicate it accurately. So it's normal to be skeptical about what you don't know about. It's like anything else. When it's totally different from what you know to be true, you have to approach it with caution. In fact, there's a great word that I find describes the reverse for purchase and even the regular reverse mortgage very accurately, and that is that it is counterintuitive. okay? Which is one of the big reasons why people just don't get it, and the misconceptions live on. So what's the old saying? Trust but verify. So don't take my word for it, prove it to yourself. Let's talk dollars and cents. Does anybody here want to make a mortgage payment during your retirement years if you have a choice? Probably not. Most would answer no. So what's the only way you can live in your new dream home and not make a payment? You got to pay cash, correct? You want to buy a $400,000 house? You sold the farm in Pennsylvania? You want to be closer to your grandkids? You got $400,000 in your pocket? Ida Walsh finds you a home for $400,000 and you pay all cash. Okay? Now all your cash is tied up in the bricks and the mortar, which means you can't use it and it's not growing. It's now basically illiquid unless you sell the house or do a refinance, which in many cases doesn't make sense, especially since you're buying your dream retirement home. So you have an incredible option now that allows you to put a minimum amount down and keep the balance liquid to invest and grow for you. So what does this mean? You don't have to use all your cash. We can come to the table with the rest of the cash necessary, and you never have a mortgage payment. Okay? This is a little detailed, and you may not be able to see it all that well, but I'm going to run down it real quick with you, and we're going to use a purchase price of $200,000, which is, I think, Arkansas, certainly not Chantilly. Anyway, we have a regular mortgage. If we put $40,000 down on a $200,000 house, that's $40,000, 20%. We'd have a 5% 30-year fixed loan at $810 a month. That's going to cost us about $9,700 a year. And over 7 years, we're going to spend about $108,000. In 10 years, we're going to spend about $137,000. In 15 years, it's up to $185,000, and in 20 years, we've spent $234,000. So that's option two. Option one is that you rent, and we haven't even gone down that column. If you're listening to this webinar and interested in this, you're not going to be a renter. So option three is that we use the HECM program to purchase the house, okay? So this means that our payment is $0 per month. We put $94,000 down. That's about 47% of the $200,000 purchase price at age 75. You have no payment. You're not paying anything per year. Over 7 years, there's a 0. Over 10 years, there's a 0. Over 15 years, a 0. Over 20 years, a 0. So that your total investment on that house, as far as the purchase is concerned, is that down payment of $94,586, okay? The other option that we talked about is to pay cash, and there are some disadvantages to that. Every situation's not the same, but I think you can begin to see how keeping some cash and never having a payment can be extremely advantageous. So option 4, you pay cash, the money's tied up and you have no growth in the money. Your home value could depreciate. So over 7 years, you've spent $200,000 in cash, and over 20 years, you've spent $200,000 in cash. And you own that home, which is an illiquid situation unless you want to leave your dream home, okay? So those are some of the options that people face. If we have a married couple at age 62 and they want to purchase that new home for $200,000, here's a problem. They want to downsize out of their big house into a smaller house and sell their existing home very quickly. So they don't want to wait until their current home sells, because the seller of the new home might reject any offer from them that includes a contingency of selling their existing home first. Now, Ida Walsh and her new home team is very, very good at negotiating favorable circumstances. But still, we want to get that house sold that you're departing from as soon as possible. So here's a solution. You use the HECM program, the H for P, HECM for purchase. You bring $103,000 to the closing table for this 62-year-old couple to purchase that $200,000 home. You can withdraw those funds. Now remember, your house is still for sale that you're leaving. You can withdraw those funds from assets accounts and replenish the funds later when the existing house sells. And that avoided them having to stay in the existing home during the sales process while the home is listed. Now, here's another situation. Gwendolyn is 83 years old. She's considering leasing a condo for $1,600 a month. And here's the situation there. She wants to keep her payment below $1,600 because she's on a fixed budget. How many people at 83 do you know are not on a fixed budget? She wants to be in a community with a pool, walking paths, activities, but not sure she can afford it. So she's confused about renting versus buying. Here's a solution. We use the H for P, the HECM for purchase program. She brings $71,000 to closing to purchase a new $200,000 condo with everything she wants. Remember, we talked about the older the person is, the less cash they have to bring. So she's really bringing only about a third of the cost of this home to the settlement table, and that includes her closing costs. So she's going to use a maturing CD to get that $71,000 for the down payment. And instead of spending it in rent for 6 years, $100,000, she only spent $71,000. She owns her home, and she lives in her dream home for the rest of her life. It makes a lot of sense. Here's a couple age 75. They want to purchase a new condo. The problem with them is they have $300,000 in liquid assets, but the husband, Nicholas, doesn't feel comfortable using all of that money to buy a home. So they're considering a $120,000 down payment and using the remaining assets to pay the roughly $700 per month mortgage payment. They're looking at a condo for $200,000, but Camilla really wants some of the beautiful options. Remember, we talked about people using the H for P are buying option after option after option. So the traditional way is the price of the existing home is $325,000. Less the fees leaves cash of $300,000. That's the sales price of their existing home. They purchase a new condo for $200,000, and they have cash reserves after the purchase of $100,000. Okay, so they haven't used all of their proceeds from the house they sold, but they remain with $100,000 after purchasing for cash. Okay, they don't want a mortgage payment. So here's the solution. They have no mortgage payments using the H for P program. They need to bring to closing only $85,000, and they keep over $200,000 from the net sale of their departure home. Okay? Years later, if they both want to live out the rest of their lives in Hawaii, okay, they can sell that condo at what they purchased it for, pay off the existing lien, which has grown to $177,000, and walk away with $72,000. So they kept liquid assets of $194,000 instead of spending it in cash on the purchase 10 years ago. Now they want to go to Hawaii. They kept that $194,000 at work, and it at only 4% compounded growth has risen to $218,000 for a total of $296,995. So they saved in mortgage payments about $26,000. You can schedule a meeting with me to get an approval letter about the home of your dreams. If you bring to me, we want a house that's on the marketplace for X number of dollars, we'll find out how much money you need for closing based on certain purchase prices and the age of the youngest person the youngest borrower. We can complete a purchase contract. That's what Ida Walsh and her team do. And so schedule time to meet with me. I can get you started and review the entire process. If you're working with a full-time professional realtor and you've found your dream home, then let's talk about how you can get into it for as little as possible and never have a payment for the rest of your life.
That's great.
You can contact me at 703-475-1555, and there's my email address as well. Okay? Thank you
Bob.
very much.
Yeah, thank you so much. I have a couple of questions.
Please.
When we were talking about the limitation on the price of how much they can borrow, it was $625,500. But is there a limit on the purchase price of what they can purchase?
No, not at all. But the what we need to remember, Ida, is that if they purchase a home for, let's say, $1 million, okay, we can only bring to the settlement table the percentage that HUD allows us to bring based on their age multiplied by 625.5.
Okay.
So let's say that we could bring 70% of 625.5 to the table. Okay, that's about what, 345? That's about 425, I believe. So that's what we could bring to the table. So if they used cash plus our 425, that's what they could use to buy the $1 million property. But we can't bring 70% of $1 million.
$1 million. Right.
We can't bring 70% of 650. We can only bring 70% of 625.5.
Okay. Great. The other question is, we were talking about retirement homes. I mean, obviously we have mainlevellifestyle.com, which focuses on main level living. So the property doesn't necessarily have to be in a 55-plus community. It can be any residential community, correct?
Absolutely, absolutely. This program is for any property out there. As we went through, FHA-approved condos, single-family homes, resales or new. There is no restriction on what kind of property that we can, aside from the list that we talked about. It can be anywhere. Okay. The buyers have to be, one of them at least, has to be 62 or over.
62. And then I know that we're seeing a lot of these multi-generational living situations now where, like in our case even, we have to take care of our mom. We choose to take care of our mom. So if it's, let's say, the parents and the kids move into a property together, is that something that's allowed with this one, where you can have multi-generation families?
The issue there, Ida, goes to the names on the title, okay? Only qualifying seniors or their non-borrowing spouse can be on the title, okay? So we can't have I had a situation like this in Herndon, where there were multi-generations living in a house, and some of the younger generation folks were actually on the title. And we were not able to help them unless those folks came off the title.
Right, but they can still be in the property, they just can't be on the title.
That's correct. That's correct.
And then obviously people are going to be asking you about how competitive are you with the interest rates? That's, because a lot of people think interest rates are the end-all for all the questions. Yeah,
the simplest way to answer that question is to say that I don't know of anyone, aside from myself and my company, Retirement Funding Solutions, that will do better in terms of rates and service and the terms of the HECM loan. Now, I know from experience of several years in this business that the rates are almost exactly the same across the board, okay? Where differences come in is when lenders begin to charge origination fees and other fees, okay? The program it's pretty much exactly the same in terms of whether it's an adjustable rate, the margins are usually the same. If it's a fixed rate, that rate is almost exactly the same for every company I'm aware of. The difference comes in, first of all, with knowledge. It's not the simplest program in the world. You need someone to walk you through it, and I've helped a lot of people. The other part is you can say, oh, well, I got the same interest rate, or I got a lower interest rate, so maybe that deal is better. We have to look at the whole picture, and I'll do that with folks, and I'll do it with competitive offers too.
Great.
I'll evaluate that.
I think that's the big thing is, and the reason that we put this basically this webinar and this video together is so that people are aware that there are options out there. A lot of people don't realize all the options that are available. Even if you're purchasing a regular home, we always sit down with them and look at what different vendors and lenders and title companies are offering, just so you're aware of the different options, because a lot of times people are just stuck with one solution and they don't investigate, they don't take the time to understand how it can help them in the long run. And that's what we really want to focus on with these information.
Education is such power. And in fact, my website, reversemortgagewithbob.com, the title of my website is Reverse Mortgage Education with Bob Adams. It's so important, especially when there's so much misinformation out there, to talk with somebody that really knows what they're doing and knows all the different variables and how they might affect your particular situation. And I like to do that in a face-to-face meeting. Most of my clients feel that that's the best way to do it.
Yeah, and that's why I think this was great, because you can actually see Bob, you can see the passion that he's got towards helping others, and the same with us. I mean, we want to help you with the transition. It's not just a sale for us, but we really want to understand your situation, where you are, and see what options we can put in front of you so that you're aware of all the different ones and understand the long-term effect, because a lot of people just kind of focus on, okay, I just need to buy a home, but what is the plan or the transition plan once you buy the home? How long are you going to live in it? So there are different aspects of purchasing a home. And we just had another session actually on somebody that was just focused on the interest rate. And when we showed them that the higher interest rate is actually a lower payment, I mean, they were blown away by it. So I think it's just the education part of it, and trusting the person that you're working with and understanding that they're going to be able to educate you through the process, give you the different scenarios based on the different options that you have, so that you can easily understand those, and really work in your best interest. Those are the three things. You got to like and trust the person that you're going to be working with, but also the experience and what they can bring to the table to help you get to the next phase in your life. And we like this program because your new home team and Main Level Lifestyle, mainlevellifestyle.com is actually for the main level living. It's mostly for people who are looking for that kind of retirement or have special needs that require that main level lifestyle. And your new home team is basically any kind of residential sales and new homes. And we were very excited that when we talked with Bob that we can actually help our clients get to a newer home, because that's been a challenge. When they sell their home, they don't have enough money to potentially qualify for their dream home, because we know how it is when you walk into a model home and everything is decked out and you think you're going to be able to get that, but obviously all the upgrades and everything else. But this allows people to be able to get the upgrades that they want or need, or even just refinance, right, Bob? If people want to age in place, you
Yes.
help with refinance as well. So do you want to talk a little bit about that?
Sure. That has been the majority of reverse mortgage transactions have been refinance transactions, where, say, somebody's living in a $500,000 house, they have a $100,000 mortgage, so they have about $400,000 in their home in equity, and they also have a $1,900 mortgage payment every month, and they're now in their 70s and their income is fixed, and so life gets a little tight, okay? And yet they have this wonderful asset that they've worked all their lives for, and they've paid their mortgage down to $100,000. What we're saying is we offer an opportunity, and through this government program, which was created in the late 80s exactly for this, aging in place was the motto, the mantra of the reverse mortgage business when it started. So we're able to offer that couple on a $500,000 house, say if they're like 70 years old, around $350,000. We take the first $100,000 and pay off their mortgage. They never have a mortgage payment again for the rest of their lives. And then we have about $250,000 left over. Now here's where an experienced professional can help to plan how that $250,000 should be used. And I work with a lot of financial planners in setting up a financial tool which creates such peace of mind and for people to be able to come up with cash if they need it in a calamity. Instead of taking that $250,000 and immediately putting it into a reverse mortgage balance on which interest is accruing from the get-go, let's say a lot of those folks don't need $250,000. So let's say that we take that $250,000 and they say to me, okay, Bob, when we settle on this, we'd like $25,000 because we want to fix the roof and we want to put new windows in. And we also have a grandchild that's starting college, so we want to help out with that. So they say, okay, at the settlement table, we'd like $25,000. Well, we still have about $225,000 left over. Let's not put that in a position where it is accruing interest from day one. Let's put it in a line of credit, okay, that if they need the money down the road, it's available to them. If they say to me down the road, hey, Bob, you know, we need in-home health care now. We're having to pay for someone to come in and help us. We need an extra $2,000 a month. Well, we can spin off that income from that line of credit that we established when they took out the reverse mortgage. It's still available. In fact, and I'm going to say this, before I say this, this will really sound too good to be true. And I've spent 30 plus years in financial services, and I still shake my head about how in the world the government allows us to do this. But here's the fact. If we put $225,000 away in a line of credit for a homeowner that's done a reverse mortgage, okay, that $225,000 available to them is growing every year at a rate of about 5%, okay? Now that doesn't mean that we're putting 5% in your pocket every year. What it means is that the available funds are growing at an amazing rate so that after 10 years, that $225,000 is worth $400,000 if they needed it, okay? So this would take a lot of detail to really explain it, and this is definitely counterintuitive.
Yeah.
But here's the bottom line. You can put aside money through a reverse mortgage that will grow over time and be available to you anytime you need it, no matter what happens to the value of your home, unlike any other home equity line you've ever heard of. So I'd love to sit down with people and explain that one. Okay.
Yeah. And I think the important thing is if you're looking at these kinds of opportunities, like Bob was saying, having a financial planner or your financial planner join the meeting if that makes you feel more comfortable with Bob so that you guys can go over the different scenarios. And what I like about what Bob puts together is the different scenarios. So it's not just one scenario, but different scenarios of the options that you have. And like I said, we can do webinars. We have webinars available for some people. You know, going somewhere is not so effective, or you know, sometimes Bob, right, Bob? I mean, you can go and meet with people. We can certainly assist in the real estate aspect of it. We love helping people through that transition period. And our focus is to really build that relationship. It's not just making about, you know, the sale, of buy or sell, but we really want to understand how do we effectively help you through that transition and help you and your family effectively go through that transition so that everybody feels comfortable. And this is why we bring in the tools and the knowledge and the experts in the different fields so that we can provide you with the information that will at least provide you with some background on the options that you have. So again, Bob.
You're doing something that, as I said at the outset, is very forward-thinking and very progressive and goes beyond what people would normally describe as the role of a realtor. Things have changed dramatically, and your role now is not just picking a house and a price and doing the paperwork, okay? You are opening up possibilities for people to be able to live in places that they might never have thought possible, okay? Through a lot of different ways that you're presenting things to the public and potential clients. It's highly unusual, and it's very, very valuable, and I'm really, really grateful to be a part of it.
Well, thank you, Bob. I really appreciate your time, your presentation, and we're going to have more information from Bob, hopefully some more webinars where you can ask live questions. And if, like we said, anybody wants to understand more details or specific options that you have, you can directly call Bob. And Bob, what was your website again?
It is reversemortgagewithbob.com. It's a little lengthy, but there it is, reversemortgagewithbob.com.
Great. Well, if you guys have any questions about the webinars, about Main Level Lifestyle, or how we work in our team, or about reverse mortgage, or any other questions that you may have, please give us a call, and we look forward to meeting you in person, and if not, maybe via webinar first. Make it a great day.
Thanks,
Bob.